Hello, all, and thank you for joining us today for a quick Let's Talk session with Portfolio Manager Marc Gagnon. Marc has an MBA from Laval University and received a CFA designation in 1995. He has 20 years of portfolio management experience with IA Investment Management. Marc manages several funds for us, including Canadian Equity Growth and North American Equity. But today we're going to focus on a specialty fund that has had a tremendous year, being up 26% as of today, December 22nd, 2021. Marc, thank you for joining us today. Your real estate income fund offers some diversification to traditional Canadian equity plays. Would you mind reviewing this fund for us, and afterwards we can go through a few questions?
Yeah, no problem. Thanks a lot, Jan. It will be a pleasure for me to talk this morning a bit about REITs. So yeah, I've been managing a REIT fund for IA for more than 15 years now. It's a quite interesting fund. It's a fund that invests in public company, and I will already do a pause here because I want to explain that that's an important difference. It's some other real estate funds out there invest in physical assets. So sometimes, if unfortunately there's a crisis, they can, stop people being able to withdraw their money because they're simply going to say, hey, we need time to sell those physical assets. So it's not the case with the IE Real Estate Income Fund. It's really investing in public REITs that are traded on the TSX or the Venture, most of them on the TSX. So we're talking about fairly liquid investments. So a REIT invests in or operates or finance income-producing real estate assets that include shopping malls, apartment buildings. Here we're not talking about homes or condominium. It's really mostly apartment buildings, offices, industrial properties, or a mix of these different assets, sometimes 2 up to 3. What's also interesting with REITs, they distribute most of their income in a tax-efficient manner. What does it mean? It means that the profits are not taxed at the REIT level. They are taxed in the end of the unit holder. So if the unit holder owns the fund, the investment in his RRSP or his TFSA, there's no taxes being paid, and I think this is a great thing. So usually distribution yield are also interesting, higher than the dividend yield and the TSX. Right now, the index, the TSX Cap REIT Index, because there's an index for REITs, the distribution yield is 3.7%. And the yield of the TSX right now is 2.9%. So once again, you gain a little bit on that front too. What is another very interesting thing to know about the fund too is that although it invests mostly in REITs, it doesn't invest all the time only in REITs. And what do I mean by that is the fund can own dividend stocks. Canadian equity stocks, or that offer an interesting yield most of the time. And that allocation can go between 0 and 30%, depending of my views on the REIT market and the equity market. So, for example, if I think that REITs are fairly valued, I can lower the percentage of REITs in the fund and redistribute that money to dividend stocks. Why do we do that? It's for diversification purposes, and we think that it's quite an interesting feature for that fund that helps to decrease the risk. And I'm going to talk a little more about the results on that front in a couple of slides. But right now, let's mention what do we look for when we talk about REITs? What are the REIT selection criteria that we're looking at? We like a REIT with a strong balance sheet, below average valuation, an opportunity to grow cash flow faster than the average or faster than the other REITs, and with a distribution yield above average. So what we like is to find at least 3 criteria, a REIT that offer at least 3 out of those 4 criteria. Strong balance sheet is always important though, but we are looking for a REITs that can offer as most as possible of those criteria. So if we take now a look at the historical evolution of the asset mix inside the fund, you can see that very recently with the pale blue bars, that the weighting in REITs has been fairly high, above 85%. That means that we're quite positive. We have been quite positive for the last year on the REIT sector. The dark orange part of the bar is the equity. You can see that it was a little higher in the past. Now it's a little smaller. And the dark blue is the cash level that we maintain in the fund. So this is the historical diversification for the last 6 years. So this really proving itself in terms of results? We think so, and the slides provide some results on that. You can see the risk return profile of three data point here. The first one, let's look at the first one, the TSX composite. That's the red dot. So you can see the return on the y-axis, a little below 9%, and you see the risk measured by the standard deviation. On the x-axis, it's about 11.3. You see the green pentagon, that's the S&P TSX Cap REIT Index that I mentioned previously. So the return is a little less and the risk is a little higher. So the index by itself might be a little less interesting, but look at what we have done with the fund, the blue dot with the IE Real Estate Fund. You can see that the return is above almost 1.4% than the TSX, a little below 10.5, 10.4, 10.35 to be precise. And although the risk is a little higher than the TSX, it's much better than the S&P TSX Cap REIT Index. So on the risk return profile, I think that we were able to gain and to show a very interesting combination. So let's talk now. Is it time to still invest in the REIT sector? As Jan said, the performance has been very good this year. The fund is up more than 26%. So is it still time to invest in that sector? We think so. We look at the two indices, the Canadian equity measured by the S&P TSX composite and the REIT index measured by the TSX real estate. And we start at the end of 2019 or the beginning of 2020. And both indices went down about the same level during the pandemic. But since then, the TSX has rebounded more, and there's still a gap with the REIT index. The gap is still more than 10%. So we think there's still some ways to recoup some of the difference. And we are quite also interested by the profile for the REIT in 2022. So we think that it's still a good time to invest. So why, or more precisely, why we think the REITs can still offer interesting return in 2022? Well, putting aside Omicron, that should be pretty quick to unfold. We think that we're heading toward a strong economy in 2022 in Canada. That will help the residential REIT subsector. We see immigration coming back. That will help also the retail subsector. We see strong consumption. Consumers are flush with cash. And we see also workers eventually coming back in the office sector. Although we have to mention that the office subsector, we own only one REIT. It's Allied Property REITs. And what is interesting with that one is that it invests a lot in assets that are what we call beam and bricks. So we're talking here about old beams, offices with bricked walls, with a lot of charm that people like to work there. With a lot of technology workers, for example, like to work in that kind of environment. And we think that the streets will be one of the fastest one to recover in the office space. It's been a REIT that has always been expensive, so we thought that it was a good opportunity to build a position in that name. If we continue, we see that e-commerce continue to grow. That helps a lot industrial REITs. Why? because industrial REITs are mainly warehouses where you use that as a hub spot to distribute the parcels that are now more and more frequent with this type of shopping. And also one thing that is very interesting for 2022 is that REIT offer inflation protection through rent adjustments. And we will come back to that in one slide. Before, I just want to show with the graph on the right, the subsector allocation of the fund as of 2 days ago, actually. So we are slightly underweight we measure that with the blue bar, slightly underweight retail, but very close to the index. We're overweight residential, underweight office, slightly underweight industrial, slightly also underweight healthcare. These are REITs with tenants involved in the healthcare system. And we're also a bit underweight diversified, but we own some service companies that are closely related to real estate. For example, Collier Lease Broker or Storage Vault, a storage unit company. So these names did fairly well in 2021. So let's talk a bit about inflation. You might have heard that inflation right now is a pretty hot topic. It's on the rise. You can see that on the graph on the left. The latest PCI reading in the US shows inflation at 6.8%. It's been a long time since we have seen that. And why it's positive for REITs? Because usually there's a lot of REITs that their rents escalation are based on inflation. So if you see higher inflation, that means higher revenue for those REITs. And that's where it becomes very interesting. But what is even more interesting these days is the fact that even though inflation is high, we have seen interest rates rise a bit, but not that much. So on the liability side of the balance sheet, the REITs have a lot of, like every real estate company, some debt, but the cost of their debt hasn't risen that much. So they benefit on the revenue side, but they don't have to pay as much on the cost side. And that is illustrated with the graph on the right, where you see the difference. We have really seen the difference between interest rate and inflation being that wide. So let's talk a bit about why we like residential REITs. Like I said, I repeat myself, these are mostly apartments REITs. And immigration is really important for that kind of demand for those kind of assets. So we see on this graph that immigration has been coming back in Canada for the last 3 quarters after going down substantially for the 3 quarters of 2020 during the pandemic. And we can see now that rents have recovered also what they have lost in 2020 so far in 2021. And it's forecasted that in 2022, they will be above pre-pandemic level of 2019. So the sector is quite attractive right now, the subsector. We also think there's still room for retail in Canada. Some people were very worried about retail. We were at the trough of the pandemic, but soon enough we realized that their future was not always only dark. There were some bright spots for them. For example, and you can see that in the quote in the middle of the page, 73% still of the people want to do their shopping on multiple channels. That means they want to do shop online, but they want also to shop at a physical place. They want to be able to go see what is the product. They want to be able to pick it up at their physical space. They want to be able to return it there. So there's every omni-channel profitable strategy out there is realizing that physical spaces are still needed and are still important. So that covers what I wanted to present you this short presentation about the IE Real Estate Income Fund.
Thank you for that presentation, Marc. That was very informative and some good timely updates to see what you've been doing to adapt to the new COVID world for the REIT market. One topic that often comes up in advisor meetings with investors is the hot Canadian real estate market. The fund has real estate in the title. Could you explain a little bit why investing in a REIT fund is very different from buying an actual property in Canada?
Yeah, for most of the people, accessing property in Canada means buying another house, second one, or that's the kind of piece of real estate assets that are available. But the REIT doesn't invest in personal houses. So most of the time we're buying a commercial piece of real estate, and that's a fairly bit difference. I would say that evaluation is also a bit on the high side for real estate, commercial real estate in Canada. But as long as real estate doesn't go up in a significant manner, it means that, like the rest of the equity markets where multiples are fairly high right now, there's still good money to be made, especially with good stock allocation.
Thank you very much for clarifying that for us. One last question. Let's just shift to the Canadian equity market overall. You manage two other funds for us, the Canadian Equity Growth and the North American Equity Fund. Any thoughts on the overall Canadian market going into 2022?
Oh, I'm really grateful that you asked me this question. I'm pretty excited about the Canadian market for 2022. We see very good prospect for energy companies, both natural gas or oil. We are interested also on the ESG front with companies that will improve their process to decrease their CO2 emission, for example. But we think there's still room for that kind of companies in our portfolios. We are pretty excited about base metal, copper, because on the other hand, there will be copper needed for electric vehicle that will become more and more popular. There's also all kinds of cyclicals will perform well. And we are in the camp that think that 2022 will be the second year in a row that the Canadian market will outperform the U.S. market, Jan.
Wow, that's great information. Happy to hear that you're so excited about what's around the corner for next year. Marc, let's end it here. Thank you very much for your time and insight. You're a great asset and role model to other PMs at IA, and your efforts are much appreciated by your colleagues, advisors, and investors that buy into your funds. As a reminder to everyone, the Real Estate Income Fund is available in both 75/75 and 75/100. And you can use our EVO online savings program to easily get clients invested in this fund and other funds. Reach out to your local sales team for more information. Thanks everyone for stopping by. Merry Christmas and have a happy holiday season. Thank you again, Marc. Appreciate your time.